All right, Tim. So I'm curious, what is the biggest mistake investors making in
2025, FOMO, people trying to get in on the newest crypto stock, Bitcoin treasury stock, chasing hot trends. But I think that's not really new to 2025. That's just mistakes that investors make on a regular basis. We get sucked into the story, we get sucked into the hot trend, the hot theme. Typically, that doesn't end well. It's nice if you can ride it up, but trying to get out at the top is just timing the markets. Markets are doing well. There are pockets where it's starting to get a bit frothy, a bit bubbly, but I think that's a mistake that a lot of us are prone to just because it's human emotion. We are quite attracted by the possibility of getting 1,000% in 5 weeks versus putting your money to work and investing at 10% a year is utterly boring in comparison. So I would say that is something that attracts a lot of people, and that's no surprise. I think it's important to protect your capital, your wealth over the long term. Going all in or FOMO into something happens a lot, and people end up regretting it. So I think in 2025, that is one area, but I don't think it's gotten to crazy levels yet in terms of people putting money into things. But I would say that's something to watch out for, especially with markets at all-time highs right now. There's a lot of hype around AI, crypto, what they're doing in Bitcoin. I would say that's an area to be aware of and careful of as an investor.
I get those YouTube ads all the time. You want to invest in this, you want to invest in that. I'm the sucker that's going to do that. But apparently it's working. Otherwise, you wouldn't be investing in things like that. Chasing trends, these short-term
Mm.
get rich quick schemes. What is something of personal finance tip that maybe not a lot of people are talking about? Because we hear a lot about these low-cost index funds investing in short-term things like treasury bonds, particularly in Singapore or the US. But is there something
Mm.
that is not something that is regularly talked about that you think, oh my gosh, this is a missed opportunity?
In terms of an investment product, there's nothing secret, as you mentioned, low cost wise. It's putting your money to work in a super boring index fund that is going to deliver 8 to 10% annualized, right? If there was a secret path to riches, we'd all be on that train, right? And being like, yeah, let's do this. I'm going to get 50%, 100% a year. And that there's no volatility. Great. I'm in, but that doesn't really exist. So I don't think there's anything out there that investors are missing out on in terms of the next growth story. If you are invested into stocks, you're by default probably invested into AI because you're invested into Microsoft, Nvidia, Meta, all the big guys anyway. So it's not as though you're missing out on a lot of those gains in AI because as a lot of these indices are exposed to artificial intelligence. I don't think you're missing out on anything. One mistake investors make, at least in Singapore, from my experience, is that people tend to be a bit too conservative
Hmm.
and they hold maybe too much cash or they hold things in T-bills and Singapore savings bonds, short-term instruments for too long. So they hold on to this allocation for maybe 5, 10 years rather than saying this is a short-term allocation that I need for me to meet my expenses. For the allocation beyond that, if I don't need this money in the next 5 years, where can I get a better return from that money? The ideal answer would be in stocks because that's the best long-term asset to invest in. So I do see a lot of people maybe being too conservative, thinking they're going to be too much into bonds and saying markets are all-time highs. I can't invest. But actually, if you look at the forward returns from when you invest at an all-time high in the market, they're not that different from investing at any other point because markets tend to have momentum. So investing at an all-time high from a psychological perspective can feel uncomfortable. You're like, oh, I'm buying at this peak, and in the next 3 or 6 months, it's going to fall and I'm going to lose money. But that's exactly the wrong way to look at it, right? Because you're putting money to work now that, as I've always said, you should have in the market for at least the next 5 years. You don't want to be taking that out of the market. As we've seen in historical data, if you put money to work at an all-time high, 1 year from now, the average is not going to be that much less from had you invested it at any other time. So it's important to remember that. I like to look at the data points, understand what's happened in history and markets. And I think that helps you ground yourself when you're investing, puts things in perspective, and it makes it more comfortable psychologically speaking, because I can understand totally for a lot of people, you don't want to put money into the market when it's at an all-time high, and especially with uncertainty and Trump trade wars. There's always something, right? Always something that's saying, don't invest, put it into cash, put it into bonds because the world is going to fall apart, or get into gold because no one's going to have faith in the US dollar and it's going to be debased. These trends take time to play out. But if you look back over 120 years, 130 years of data, stocks tends to be up and to the right, just not in a straight line. I think we forget.
I've been guilty that it's the right time, it's the wrong
Yeah.
time. But your advice would you say, hey, just put it in there. As long as it's for the long
Yeah.
term, it's going to get a decent return out the back of that.
Yeah, exactly. We're all prone to timing or wanting to time the market. That's the thing I've done in the past as well. You think, oh, I don't want to put all of it in now, or I don't want to buy this. But if you sell something, I found this as well. If I maybe haven't, I've lost faith in an investment or something. If I sell it, you have the cash. The reaction is to think, wait for the market to fall and buy it. But if you're selling, you should know what you're going to buy next, or you need to meet an expense, right? So you can use the money. You don't want to sell it and not have a plan for the money. I think that's what a lot of us get caught up in, selling it, either spend it, which is fine, or reallocate it and buy straight away, put it back into the market. I think that's key, not to doubt ourselves, to be like, oh, I don't know. Just pulling the trigger is the hardest part for a lot of investors. But once you do that and have a plan and strategy, it makes it a lot less stressful and easier to move with the ups and downs that the market throws at you.
Yeah, you briefly mentioned your portfolio. Would you be open to sharing? Obviously, you don't have to share everything, but how you allocate yours? Is it in index funds? Is it in, how do you break it up, if I can ask?
Invested when I was younger, interested in stocks and businesses. Started in that, used to have individual stocks and some funds. But as I've gotten older and in my 30s, in the past 5, 6 years, I've transitioned away from holding many stocks to market ETFs, like a global index ETF or tech focused ETF like the NASDAQ. I've moved more of that in there, but I still hold a portfolio of stocks focused on dividend generation. Being in Singapore, it's great to have dividend income because it's tax free for us in Singapore, and also like maybe a few growth stocks in the US. But I've tried to focus on automating my investing, my monthly investing that I just put away every month. That's into like index funds and ETFs and the basic, boring, vanilla stuff. So I think when you automate it, that makes it easier. If I have spare cash and find an interesting opportunity in a stock I'm familiar with, I might add to it. But at this point, I'm not exploring new stocks or following new stocks because I don't have the time to find the next NVIDIA and research that. I know the companies I hold and I'm familiar with them. So that's good for me. I'm focused more on moving into ETFs, automating that, like having a bit of gold, having a small allocation to Bitcoin through an ETF. Nothing too crazy. I've moved away from focusing on individual companies.
Mm.
I'm moving towards broad market investing because over time, that leads to the most optimal results for the least amount of stress and
Mm.
effort.
Can I ask
Yeah.
what tool you use when it comes to automating your monthly investments?
Yeah, sure. I use Interactive Brokers in Singapore as my platform. It's easy because they have a recurring investment plan. You can automate it, asking them to take out, I don't know, what the amount is on a certain day of the month. And that could be every month, that could be weekly, that could be every fortnight or every quarter, whatever period you want. They're very flexible. As I've always said about European ETFs, they're tax efficient for us outside the US. You can automate it into London listed ETFs. Interactive also allows you to fractionally buy shares, right? So say a share costs $500 and you only want to buy $300 every month, you can buy zero point 0.6 or zero point 0.7 of that share in terms of shares. So you don't have to buy a full share. You just set a dollar amount. It gets taken out of your account on that day, and then they buy it a few hours after the market opens or before the market closes on that day every month. For me, it's every month. It's done automatically. Don't have to think about it. Dollar cost averaging makes sense, and it matches with people's cash flow. Putting in massive lump sums every month or every 6 months, you're going to be working with your cash flow. And so automating it so that it aligns with your crediting of your salary or when money comes in, and for it to come out first, pay yourself first, that whole mantra about putting money away for saving, investing first. I think that makes it a lot easier. Automating that whole process so you don't have to think about it, it just makes it way easier and you can live your life and not worry so much about what the markets are doing.
Yeah, you mentioned
Yeah.
tax efficiency. Now, obviously, this is a
Yeah.
bit of a tricky part, and I guess it depends on where you're staying. I'm in Singapore, but I still have my US passport, so I have to deal with that. What are some tips when it comes to tax efficiency, like broad scale?
Sure. Yeah. Okay. So disclaimer first off, I'm not a tax advisor or expert. If you have tax issues, see a specialist. But For most non-US investors, if you're investing into ETFs, you won't want to be investing into US listed ETFs. And that's because for US investors and US citizens, there are lots of tax benefits and advantages to investing into US listed ETFs. But for non-US investors, and especially Singapore-based investors, because Singapore and the US doesn't have a double taxation treaty, there are lots of issues with dividend withholding taxes on US listed ETFs. In Singapore, if you get a stock like DBS and it pays a dividend, you get all of the dividend, right? But in the US, if you're a Singapore resident, non-US citizen, and you get paid a dividend from, I don't know, like a Home Depot or something in the US, that 30% of that gets taken in tax and you only get 70% of the remaining, right? You get the remaining 70%. And so that's also true for ETFs. So any US listed ETFs like Vanguard, S&P 500, Spider, S&P 500, the SPY or VOO, those ETFs will pay out a dividend every quarter. And so you say you get $1 per share, you only get 70 cents as a Singapore resident. That kind of sucks. You want to compound your wealth faster, so you don't want to lose it to taxes. The UCITS side of things, a structure and a regulatory framework in Europe describes ETFs listed in Europe. They're usually domiciled in Ireland or Luxembourg, and they have a preferential tax treaty with the US. And that means that you only get taxed 15% of your dividends instead of 30. The great thing for ETFs in Europe is they automatically reinvest your dividends into the fund to compound your wealth, right? So whereas US listed ETFs, typically they'll pay you in cash, the dividend, and that's going to be taxed at 30%. And you have to decide to reinvest it yourself. So the great thing about UCITS ETFs, at least in Europe, is most of them are what we call ACC, so an accumulating share class. And that allows them to just take the dividend at the fund level and then reinvest it for you so you can compound your wealth faster. So as you can see with share prices, compare VOO versus CSPX, a UCITS ETF that tracks the S&P 500 in London. If you look at it over 5 years, 10 years, the share price performance would be better with the UCITS ETF because it's got that reinvested dividend that allows you to compound your wealth. So I think for most people who are not US citizens, it's preferable to be in UCITS anyway. The second thing, again, which is another big thing, is the US estate tax for non-US citizens. If you have anything US securities over $60,000 worth, once you die, like you're going to get taxed on that by the US federal government. They're going to tax you up to 40% above the threshold, which can be sizable, right? 60,000 is not a very big tax-free amount for you to enjoy. So if you own over 60,000, you're gonna get taxed a lot. Whoever inherits your portfolio or your money is going to tax a lot. So that's something to think about as well from a post-death perspective.
I'm gonna start crying if we talk about taxes too much. I still have the US passport.
You're the expert, Joe. You must
Oh,
know
no, no.
how much of a headache it is.
Yes, it is extremely complicated, costly to be a US citizen
There's like
nowadays.
a lot of software programs that help people file their tax in the US because it's so complicated to do it yourself. You need a program to do it for you.
It's wildly complicated. That's why I love Singapore. It's straightforward.
It's so simple.
I wish every
Yeah,
place was like this, but that's a different story. So that's some very good tips for non-Americans. Hopefully myself one of these days.
yeah,
But until then, because yeah, I think everyone
yeah.
should to go to the traditional route. Another thing you talked
Mm,
about, I made this mistake. So I made all these mistakes, and I'm glad you're sharing this. I think I saw one of your newsletters is the cost of the index funds. Because I remember I
mm,
was going with a I don't know, American Funds or whatever it was called at the time. I probably got ripped off. I bought it when I was like 18, but the
yeah,
management fees were like through the roof. And I didn't know at the time.
yeah,
Like I said I was 18. I got suckered into buying it. And then I
yeah,
switched to a lower index one, Vanguard. Massive difference, I
yeah.
guess, over the long term.
Yeah, Joe, when I talk about fees, the financial industry doesn't function like other industries, right? So if you think about fees, you are paying more fees, you'd expect it to be better. Say you go on Singapore Airlines SQ, you go on economy class, you pay $1,000, you get economy class service. You
Hmm.
go to business class, you go to first class, you're paying $20,000 on first class suites or whatever, and you get caviar and you get your own bed and whatever. It's better. It's a better experience with financial services. They charge you more and typically you'll get a worse result. So you're paying first class prices and you're getting economy class service. But if you're paying economy class prices, typically with an investment product, you'll probably get first class results. With an index fund, you pay economy and get first class. You get to go in first class for economy class. But when you're buying like an actively managed fund that charges, I don't know, 2.5% per annum or 1.5% per annum, It's like you're paying first class fees, but you're getting served like cold, sort of sturgid food in economy class. It makes no sense from a cost and results perspective. Cost wise, you think, oh, that makes sense. I'm paying more, so I should be getting a better experience or a better result. But that's actually the wrong. In financial services, it's the other way around. If you go with Vanguard, you go with iShares, and you pay close to 0%, you're going to get better results over time because the whole active management industry, it's extremely difficult to beat the index over long periods. I'm not saying people don't beat it year to year. They do. They can beat it one year. They can maybe beat it another year, 2 years. I'm saying to replicate that outperformance every single year for 20, 25, 30 years, a tiny sliver of fund managers can do that. And that's very difficult. It's almost like picking stocks when you're trying to pick a fund that can outperform a basic benchmark like the S&P 500 or the MSCI All Countries World Index, right? Trying to find a fund that can beat that consistently for 20 years is nearly impossible. And it's just going to be way too much trouble for you because you're going to be switching funds. You're going to switch to this fund, then you switch to that fund because you're like, oh, they've just outperformed. So I think there's that aspect to fees in the financial industry. They're getting their margins squeezed because people are realizing ETFs are low cost, they give you better results, and it's stress-free investing, right? So you've seen the rise of ETFs. It's just been like a straight line up in terms of assets under management. All the big guys are in there, right? The iShares, Vanguards, State Streets all have huge ETF businesses. No surprise because ETFs wouldn't get that big unless there was a demand for it, unless they were delivering results, and they have delivered results. So it all adds up. The analogy I always say, it's strange. If financial services products, it's strange. The more they charge you, the worse the result seems.
I bought these long before Vanguard was big 20, 25 years ago when I started
Yeah,
investing. I wish I would have known this now. So I'm glad you shared that because I made that mistake or didn't learn until later. I would say the past 10, 15 years. You live and you learn.
yeah. It's all about educating yourself and learning. The great thing about investing is anyone can do it. Educate yourself, the data, what's happening. You don't need a finance degree. I worked in financial services and I have a history degree, right? So I came from that arts background. But if you have basic maths knowledge about yields, rates of return, about the historical data, like you can deal with that, which is straightforward. Investing is more about the mindset rather than, oh, I've got to pick this like winnings like fund or pick that winning ETF or do this. It's about allocation that you have. And then from there, it's just sitting tight and being patient. And that tends to lead to results that are better than most people.
No, it makes a lot of sense. My last question is you mentioned resources. What are your go-to resources? You mentioned Motley Fool used to work there, so I'm guessing you have to plug that. But what else would you
Yeah.
mention?
Motley Fool is good. I had a good time there. It is a very stock centric company,
Mm.
obviously, because they sell a stock advisory service. They have had some great picks. They've also had some bad picks, but they have had some really good early picks. That's more interesting just from a reading about companies perspective. If you're interested
Mm.
in businesses and they have a good way of engaging the audience for what a business does and like why it's interesting. It's more about keeping up with news and business. I like to read online, just consume sort of news, what's happening, understanding where you can access interesting information online. There's a lot of good financial websites for anyone who's interested to learn more. Investopedia is great for people who
Mm.
just want to learn about concepts of investing, right? Or what is like a rate of interest or what is like a CFD or something. If you put that in and ask Investopedia, they'll be able to give you a good explanation of what it is.
Yeah.
I guess for more market related stuff, I'm just the usual, right? It's like Bloomberg, like the FT. I read a lot of The Economist. I like The Economist. I like to keep up with what's happening, and they have a good analysis of market dynamics in different regions. I've always been interested more in politics, maybe historically than financial markets. I got into financial markets because it was interested in investing from a younger age, but I've always been interested in politics and international relations and that kind of setting. But it's an interesting time with Trump and how that's playing into markets. Politics has become a lot more influential in markets in the past 3, 5 years. Politics impacts everything. I wouldn't say I have one go-to source for investing, but if you are just looking to understand more, Investopedia is a good one to understand about markets, general markets. And if you do find interesting newsletters out there, have interesting analysis from different houses, analysts. One newsletter I subscribe to is called The Idea Farm. And that's really interesting. That gives you a lot of technical analysis on certain sectors, regions, what's happening. But that's a bit more in the weeds. That's a bit more financial focus. So I think for most people, just sticking to like basic news, understanding what's happening in markets, just reading up on ETFs, indexes, understanding the history of markets is really useful. Actually, I used to work with dimensional fund advisors. They have a lot of good content on their website that most people can access. It talks about the history of markets. They have a lot of good content on the historical context of data points for
Mm.
markets. And as I've always said, I like to look at the data, understand how that impacts the market and how that might impact it going forward, because you need to understand what's happened in the past to understand what's happening, may happen in the future. And so I think it's a useful data point to look at as well.
Yeah, absolutely. I appreciate you sharing those. We will plug your channels as well too. I know you have the YouTube newsletter, TikTok, and the show links. But Tim, thank you so much for sharing your investing knowledge with us. We appreciate it.
Thanks for having me, Joe. I've enjoyed it.
For everyone watching and listening to today's episode,
Thanks.
feel free to share it for anyone interested in building up their personal wealth. There's a lot of great ideas here. Thank you, and we'll see you on the next episode.